short interest ratio indicator explained. The short interest ratio is a mathematical indicator of the average number of days it takes for short sellers to repurchase borrowed securities in the open market. Summary: the short interest ratio is a mathematical indicator of the average number of days it takes for short sellers to repurchase borrowed securities in the open market. The ratio is calculated by dividing the total number of shorted shares of a stock by the average daily trading volume. When the short interest ratio is high, the number of shares that will repurchase in the open market after short selling is high, and similarly, if short interest ratio is low, it means that the number of shares that will be repurchased in the open market after short selling is low. How to calculate the short interest ratio. The short interest ratio is calculated by dividing the total number of shorted shares of stock by the average daily trading volume, ADTV. To put in a formula, short interest ratio, SIR, short interest, SI, divided by average trading volume, ADTV. What does short interest ratio imply? The short interest ratio is a mathematical indicator in finance. It depends on two factors: short interest and average daily trading volume. It ultimately indicates whether it is the right time to short sell. When the ADTV is high, the short interest ratio is low. When the ADTV is low, the short interest ratio is high. Similarly, the total short interest is high, the ratio is high, and when the total short interest is low, the ratio is low. It indicates how high or how low the shorted shares are compared to the average daily trading volume. When the short interest ratio is high, the number of shares that will be repurchased in the open market after short selling is high. Similarly, if the short interest ratio is low, it means that the number of shares that will be repurchased in the open market after short selling is low. The short interest concept is inherent to the short selling phenomenon. It happens when a company's share price shows a primary downtrend and investors read an opportunity to profit from the falling price. So short sellers borrow such shares, sell them, repurchase them at a price lower than the selling price, return to owner, and gain from price differences. The short sellers decide the gap between sale and repurchase based on factors like falling trend intensity. The SI, short interest value, helps investors ascertain the current market sentiments towards the stock. It is common belief that an increase in SI value is a sign of an investor's perception of the downtrend stock price movement. In contrast, a decreasing SI value points to investors' anticipation of the upward trend of the stock price. In essence, high SI value happens when investors are bearish, and low SI value attributes to bullish investors. Furthermore, an increase in short selling can hint about future stock price crash risk. Short selling is also an indicator of weak governance mechanism, excessive risk-taking behavior, and high information asymmetry between managers and shareholders. An increase in SI value is not always an indicator of a downtrend and can also imply an upcoming uptrend. Proponents of this anticipate that downtrend will be followed by an upward movement. Furthermore, if a price rise happens instead of the anticipated price drop, short squeezers buy stocks, and panic-stricken short sellers start repurchasing stocks to avoid severe losses. All these create high demand, escalating the prices and forming an upward trend. What is the days to cover ratio? The short interest rate is often used interchangeably in place of the days to cover ratio. The days to cover ratio is similar to short interest ratio and measures the anticipated number of days to cover a position on the shorted shares issued by a company. Therefore, the days to cover ratio basically represents the total number of days for short sellers to repurchase their borrowed shares from the open market. Hence, when the days to cover ratio is high, it is a bearish indicator. Conversely, if the days cover ratio is low, it's a bullish indicator. Short interest SI versus short interest ratio SIR. The short interest ratio is the ratio of short interest to the average daily trading volume. Short interest is a part of the short interest ratio but is not the same as the ratio. Short interest is the number of shares that are sold divided by the number of outstanding shares. A key difference between them is that short interest ratio takes liquidity into account since it is considered the ADTV. On the other hand, short interest does not take the ADTV into account, hence it does not account for liquidity prevailing in the market in its calculation. Limitations of short interest. The SI value does not assure any significant change in trend or continuous of falling prices. Another concern is the limited availability of reliable SI data. Hence, it is not a prime factor in investment decisions. Furthermore, SI value data drives short squeezes to jump into stocks with high short interest to drive the price high and make a profit. For example, the excessive short interest of GameStop, GME, in the initial times led to a price surge. Short sellers are forced to purchase back shares at a price higher to close open positions when a heavily shorted stock price rises, propelling the stock price more. Based on analytics data from Ortex, shorting game shares in GameStop cost hedge funds a total of $12.5 billion in January 2021. At the start of February, again, the GME stock value declined and increased by the last week of February. The rise and drop sequence continued, and the SI value also fluctuated proportional to this. What is shorting? Before we get into detail about the short interest ratio further, let's review what shorting is exactly. When shorting a stock, you are essentially borrowing shares from the broker and selling them on exchange. If the share price drops in the price, you can then buy them back at a discount and keep the difference as profit. How to find stock numbers of shorted shares. Financial regulatory bodies require all brokers dealers to report short interest data twice a month, although the exact days may vary among organizations like FINRA, the FCA, and IIROC. Most stock exchanges also report short interest data once or twice a month. This is considered a high short interest ratio. A high short interest ratio is generally 10% or higher as a percentage of the float. Anything above 10% is thought to indicate a strong pessimistic attitude toward the stock's future price action. A short interest ratio of 20% or more is extremely pessimistic. As for days to cover, 5 or more days indicate a slightly pessimistic stance towards the stock, and 10 days or more suggest extremely negativity by traders and investors. What is low short interest ratio? A low short interest ratio is anything under 10% as a percentage of float and 1 to 4 days to cover. These ranges indicate strong positive sentiment for the stock price to rise, as so few traders are actively betting it will fall. Example of how to use short interest ratio. The short interest ratio is an easy snapshot of current market sentiment towards a stock. A higher short interest ratio can indicate the stock is faltering and not a good buy. Of course, this is up to your own interpretation because it could also indicate the stock is at a bargain and primed to rally higher in the future. You could also see the short interest ratio trends over several months. If trending upwards, it may signal investors are beginning to lose faith in the company. If short interest ratio is shrinking over time, it could mean companies' public sentiment is strengthening. Keep in mind, short interest ratio is not a perfect indicator of the stock's future performance, but it can be a good place to start for traders evaluating stocks. Doing your own research into why the short interest ratio is where it is necessary to make a final judgment before opening a position. Frequently asked questions. What is short interest in stocks? It refers to the number of open short positions of an entity's stock. Investors engage in short selling by selling borrowed shares and later repurchasing them at a low cost to benefit from the falling price. Furthermore, there is no predefined time for deciding the repurchase of short sales. What is a good short interest ratio? A high SI ratio indicates a bearish sentiment, and a low ratio suggests a bullish sentiment in the market. A higher ratio reveals that it will take a lengthy period to close the short positions. For instance, the short covering difficulty increases if the value is around 10 or more. Is high short interest bullish or bearish? Generally, a high SI is considered a bearish. Investors short sell the stock which exhibits a primary downward price movement. However, traders initiating the short squeeze utilizing this opportunity by buying the shorted shares and making short sells panic to cover their open short positions before price surge, temporarily creating a bullish trend. Furthermore, proponents of the bullish trends advocate that a bullish movement will follow a bearish sentiment in the market. What is considered a high short-in ratio? The concept of a high short-interest ratio is little ambiguous. Investors will often disagree as to just how high should be considered high. However, there are some rule of thumbs that any experienced option trader would agree with. Here are a few of them. A day to cover of between 1 to 4 usually indicates a strong positive sentiment and a lack of interest from short sellers. A day to cover above 10 indicates extreme pessimism. Short interest as a percentage of float below 10% indicates a strong positive sentiment. Short interest as a percentage of float above 10% is fairly high, indicating the significant pessimistic sentiment. Short interest as a percentage of a float above 20% is extremely high. The New York Stock Exchange short interest ratio has been gradually falling since the late 1990s, so no long-term level can be identified as a high, but over the short run, a spike upwards can indicate pessimistic sentiment towards the economy as a whole. How to trade using a high short interest ratio. Now that we explained what is considered a high short interest ratio, let's consider how to trade using this information. As with all metrics we can use to evaluate stocks, a high short interest ratio is a subject to interpretation. If a stock has many short sellers, it may be because the company is not very profitable. Maybe the company is facing market changes that have made its business model unattainable, or perhaps the management is involved in accounting scandals. On the other hand, a high short interest ratio may also be interpreted as a contrarian signal that the stock is a bargain. For example, let's say the company is developing a new product, but early reports suggest that products may be unsafe. As a result of this early report, short sellers have piled in, pushing short interest as a percentage of the float above 10%. If later on the product is proven to be safe, there may be a sudden flood of buyers, but because short interest is so high, a large number of short sellers may be forced to cover their positions. This can be quickly push the stock price even higher, causing a strong rally. Because of this potential for sudden rallies in the stock market that have short interest ratios, many seasoned option traders consider the metric to be a bullish indicator. Short ratio summary. There are a number of different definitions for what the short interest is. It could mean the number of shares shorted for an individual stock as compared to the daily volume, the number of shares shorted for an individual stock as compared to the total public float, or the number of shares shorted on the entire New York Stock Exchange compared to the daily volume of the entire exchange. Regardless, most option traders would agree that if a shorted interest ratio is defined as the number of days to cover more than 10 days is pretty high. Likewise, short interest as a percentage of float above the 10% is pretty high, and above 20% is extremely high. These high ratios may indicate that a company is in trouble, so if you may want to join the crowd and go short, or you think there's a good reason for this company to have a high short interest ratio, you may want to go long to take advantage of the coming short squeeze. So the catchphrase. So for the short interest ratio, study it, analyze it, adapt it. Peace.